That's Sandra's job. So. Good morning. My name is Bruce Kogut. I'm the director of the Sanford C. Bernstein Center for Leadership and Ethics. I'd like to welcome you here this morning. We are actually all rather excited about this conference. I'm very pleased to have worked on it with Patrick Bolton, who's going to be here for the first panel, and also with Tano Santos over here as well. So we're worked very well together, and we're pleased to also have the support of Sandra Navalny and of Carolyn Tharp on this project. The reason why I mentioned this early on is we have such a full day. I want to make sure we have a chance to thank the people who put this together. And Sandra's the co-director of the center, and it was quite important to have her help and her assistance in pulling this together today. This conference obviously is very timely, and we had a large response of people who will be coming in during the course of the day, and we also have a very strong set of people. And I want to give you a little bit of a sense of what we'll be discussing along the four sessions we have. We also have a session to end with three noted journalists. And putting this together, we were thinking about the issues of preventing the next financial crisis. This was a title we came up with last January, February, and to be quite honest, we thought it would be over by now, and we would just be looking backward and have the wisdom of hindsight and going through this whole thing. But that's not it's not turned out that way. We may be having this conference about preventing the next financial crisis next year as well, given the current trends. Let me go through very quickly some things which Patrick and Tano and I have thought about in this context, and what we're trying to achieve today. We are going to have a conversation about the origins. We're going to have a conversation as well as about policy responses. There'll be a lot of people talking about what did the Fed do, what did the Treasury do, what could have been done actually better. And also we're going to then come during the course of the day to issues of recommendations. We had a conversation last night, and clearly there's a lot of controversy about recommendations. Some of the issues are quite technical, involving very complex ideas, and this is a good area to start that debate. The origins, we'll have many people talk about this, but the very broad origins had to do with a series of crises which are still going on. This is one of many. Of tremendous liquidity in the world economy, perhaps interest rate policies which were a little bit too generous during the early 2000s. And then finally, what we call the weak link in the loan chain. This is the problem of loan origination, which is no doubt responsible for a lot of the problems in this particular crisis as an origin. We put together this chart, and we decided not to explain it because we would not have a lot of time to explain it, but just to point out to you that this is a very complicated process. Usually there's a borrower and originating bank. That was the classic model. And then around this has developed the market of securitized securities, a market of hedge funds which take equity into these vehicles, off-balance sheets, people who specialize in servicing the loans. So there's a large industry around this, and any one of these points, you might say, is actually vulnerable in terms of this loan chain. We had debates with politicians. Poul Rasmussen came here not long ago from Europe talking about whether or not securitization is a good idea or a bad idea. I think for most of us that's not the issue, but it's rather why it is that in this particular process, which generally brings such good to the world, failed and caused this crisis. In looking at the pattern of the weak links, we highlighted the loan origination as being really critical, but there are also other things which will be mentioned too, which will be discussed, and sometimes maybe kind of harsh words. I'm not sure if any of you are from the rating agencies or from the various other links here, but there will be some discussions around this, and we'll be happy to have your opinion along this. Hedge funds in terms of the credit enhancement will be interesting as well. And of course, you can't avoid leverage in terms of an important topic. We are looking then also in terms of what could have been the regulatory responses. And this is where the first panel and the second panel is going to cut in. Particularly the Fed's job as being a liquidity provider. This is the classic lender of last resort, which Many people love to cite, going back to a classic work in the 1800s. But we fell upon an idea of the actor of last resort, which is the role of the Treasury to address the problems of solvency itself. And a lot of the debate is, in fact, having to do with the issues of whether or not the Treasury was the correct actor in this, or who should have acted in this overall system. And then there's some people who are missing. The missing presence is the SEC, by and large. Jack Coffey last night from the law school talked a bit about that. But there are some important players who were not at the table, and that deserves our attention as well. Okay? We're doing some work with Sid Balachandran, who can't be here today, looking at early warning signals. And what's kind of interesting to look at the data which may have come to the Fed, and what did the Fed actually know? I put a red vertical slash on these graphs, which show, the past due, which were available to the bank accounts. And that slash is September 2007. And you can see that actually there wasn't a lot of trend line going on to the bank prior to that. So in many ways, information arrives late. Even the famous credit default swaps, which will be discussed quite a bit, that again, if you look at the actual activity, this is for the investment banks, that only starts in September 2008 and 7. So we don't have a lot of early warning signals in this as well. Perhaps that explains a bit of the Fed response. So the summary of the crisis has to do with perhaps too much liquidity, a lot of financial innovation, which we welcome, but certainly is volatile. This concept of systemic risk, and a term which I learned recently called adverse feedback, which Rick Michigan would talk about during lunch. And then the problem, of course, the regulators did not have enough information, which is something, and knowledge, which is something which Tano will address in his talk. Let me turn to the last one, but perhaps it's the most interesting, is what we can do for recommendations. And I just want to throw this out early on, and maybe you have a chance to come to it through the conference. Glenn will talk about his ideas on this as well, and then Patrick has the honor of being at the end to maybe pull these things together in a coherent system. Let me remind you what the problem is. We've got a very complicated market, a lot of players, a lot of links which actually could break. In fact, the links did break. And then we have a regulatory structure. Now, I borrowed this from the New York Times, so if the next slide looks a little complicated, you can ask Floyd Norris later on about their graphics artist. But this is a portrayal of the regulatory system of the U.S. For financial services. And to say the least, it's complicated. There's a lot of people you can look at, everything from the Department of Labor, which is often forgetting to the individual states. But certainly there's a complexity on the regulatory side which is bewildering, given how few actors actually seem to take control during this crisis itself. So what can we actually do? And here I wanted to cite Floyd on this. He wrote a very interesting column where he said, we can probably figure out how to prevent this particular crisis, but it's not clear whether we can prevent, in fact, the next financial crisis, which will take a different form. So we wanted to think very broadly about some issues, and we put forth a few ideas, and I'll just flag them to you very quickly. One of them, which is something I think Glenn will come to as well, is discussion of the new FSA, which is, of course, introduced in the UK, and we're thinking about along the terms of a tripartite system where you have the Fed, you have the Treasury, and you also have some collection of agencies under the same roof. We're talking about rule-based regulation, things you just can't do, and probably the important idea here is it's called skin in the game. Certainly if the loan originators kept some equity along the chain, they may have been a little more diligent in their efforts in actually screening the loans which they gave out. We have adaptive regulators and regulations. There's a lot of pro-cyclical dimensions to this crisis, things which actually made it worse than making it better, and things we're thinking about in terms of how to break this. We took Spain as an example, not because Tano's from Spain, but that may have had some influence in the particular choice of countries after all. But it did look like a remarkably sound system in this regard.